In this video, I'm going to show you 8 ways to legally pay less tax so you can save thousands of dollars per year. With tax time coming up, these tips could help you save a lot of money for this financial year and help you plan better for next year. Let's get straight into it. The first way is a salary sacrifice part of your pre-tax salary into your superannuation account. Now, if this is the first time you've heard of salary sacrifice, then it may seem complicated, but trust me, it's actually quite simple once you understand how it works. Salary sacrifice is when you ask your employer to make extra contributions into your super account from your pre-tax salary before you get paid. This allows you to reduce your taxable income and potentially save on taxes. In Australia, your employer must pay 10.5% of your salary into a super retirement account. Please note that the super rate is going to increase by 0.5% every year until 2026. Any extra super payments that you salary sacrifice are called concessional contributions, which are taxed at 15%. In comparison, if the money was paid directly to you without salary sacrificing, you would have to pay your marginal tax rate, which is usually much higher than 15%. Let me explain this better with an example. Our friend John earns $70,000 per year, which is the average full-time salary in Australia, and he wants to know how much money he can save by salary sacrificing. So let's have a look at the table here with the two options. One is if he didn't salary sacrifice, and the other is if he did salary sacrifice. We start off at 70K, which is John's before tax salary. Then we have our salary sacrifice contribution for one of our columns. Please note that concessional contributions are capped at $27,500 per year, which already includes the 10.5% that your employer must pay into your super. So John can pay an extra $20,150 into super per year without exceeding the limit. This reduces his taxable income for the year to $49,850. If John did not salary sacrifice, he would have to pay tax on the full 70K at his marginal rate of 32.5% plus 2% Medicare levy. Assuming John would have used the $20,150 to invest outside of super, once you take into account how much extra tax he has to pay, he would save $4,181.50 in total if he salary sacrificed. So you too can do the same thing as John to save on tax. If you are going to use that money to invest in shares outside of super, then you may as well consider investing inside super instead and saving on the tax. And at first it may not be much, but over the years the savings on tax will allow you to invest more, which will compound over decades. So have a chat with your payroll officer if you're interested in salary sacrificing. But please note that the downside is you can only access your super at preservation age, which is currently 60 years old. So if you do salary sacrifice, make sure you're okay with being in it for the long term. The next way to reduce tax is to claim deductions for work-related expenses. This means you can claim deductions on certain work-related items or expenses that you spent during the financial year to reduce your overall taxable income. In Australia, you can claim deductions on certain work-related expenses that were incurred while performing your job. It is important to note that to be eligible for deductions, the expenses must meet a specific criteria and be directly related to your work. Here are some common work-related expenses that you may be able to claim deductions on. 1. Vehicle expenses. If you use your personal vehicle for work-related purposes, you may be eligible to claim deductions for expenses such as fuel, repair and maintenance, registration, and insurance. However, you generally cannot claim the cost of driving between your home and workplace, but you can claim the cost of driving from your workplace to a client or work-related destination. 2. Travel expenses. If you need to travel for work-related purposes, you can claim deductions for expenses such as accommodation, meals, transportation, e.g. flights and taxis, and incidental expenses. The travel must be directly related to your job and you will need to record your expenses with receipts. 3. Home office expenses. If you have a dedicated area in your home used exclusively for work, you may be eligible to claim deductions for home office expenses. This can include a portion of your rent or mortgage interest, utilities, internet, phone bills, and depreciation of home office equipment like computers and furniture. 4. Work-related self-education expenses. You can claim deductions for self-education expenses directly related to your current employment or to maintain or improve your skills for your job. This can include tuition fees, textbooks, stationery, and travel expenses for attending educational courses or seminars. 5. Tools and equipment. You can claim deductions for the cost of tools, equipment, and other work-related assets that you purchase or repair as part of your employment. You can even claim a deduction on laundry and dry cleaning expenses for your uniforms. 6. Other work-related expenses. Other work-related expenses that may be eligible for deductions include professional certifications and licenses, work-related phone calls, work-related subscriptions or publications, and expenses incurred for income protection insurance premiums. There are a few more expenses you can claim, and I'll leave a link down below to this article on the ATO website, which provides the full list of what you can potentially claim and how to claim it. I would personally go through this entire list so you know exactly what you can claim, so even if it doesn't help you this year, you can be strategic about what to buy next year. Also, please note you can claim up to $300 without any written evidence or receipts, but if you do go over $300, you will need some kind of proof to justify the deduction. A helpful tip would be to download the ATO app, which allows you to take photos of receipts and documents during the year and save them directly onto the app. That way, when it's time for tax return, it's all there waiting for you. The next way to reduce tax is to have a capital gains tax strategy. If you're watching a video like this, then I'm assuming you're an investor or you're thinking of investing. In Australia, when you sell your assets like stocks or real estate for a profit, you must pay capital gains tax. However, there are a few strategies you can use to minimize the tax you pay. Here are 3 ways. Number 1, if you hold your assets for more than 12 months, you will receive a capital gains tax discount. This discount will reduce the taxable portion of your capital gains by 50%. So for example, if you sell your shares for a profit of $500, you only have to pay tax on $250 if you waited more than 12 months to sell. So that is a significant saving just by waiting. Number 2, you can offset capital losses against capital gains to reduce your overall tax liability. So for example, if you made $1,000 profit on stock A and a $500 loss on stock B, you would only be subject to tax on $500 since the loss offset part of the profit. Also, please note that if you don't have enough gains to offset your losses, you can carry over the credit to offset any future capital gains. However, you cannot use capital losses to reduce your taxable income. Number 3, consider the timing of selling assets to strategically manage your capital gains. So for example, some investors sell their stocks at a loss right before July to lock in the losses for the current financial year. This is particularly useful if you also made some gains so they can offset each other. So you might be thinking, what's stopping me from selling a stock at a loss on the 30th of June and buying it straight back the next day so you can get the tax benefit? Well, this is called a wash sale and it's illegal. The ATO does not like investors buying and selling assets just for the tax benefit. And if you try this, they may audit you, so please be careful. The next way to reduce tax is to maximize deductions for investment properties. Real estate is a tax haven for investors because besides the obvious benefits of rental income and asset appreciation, there are so many tax deductions you can claim. So if you own an investment property, ensure you claim all the eligible deductions. This can include expenses related to property management fees, repairs and maintenance, interest on loans, insurance, and council rates. Make sure you keep a detailed record of every receipt, invoice, and documents throughout the year so you can easily produce them when required. Reducing tax with real estate in Australia can be achieved through various strategies. However, it's important to note that tax laws and regulations can change, so it's crucial to consult with a tax professional or refer to the ATO for the most up-to-date information. Here are some potential strategies to consider. Number 1, negative gearing. Negative gearing involves borrowing money to invest in property where the expenses, e.g. mortgage interest or maintenance costs, exceed the rental income. The resulting net rental loss can be used to offset other taxable income, reducing your overall tax liability. However, it's important to carefully consider the financial implications and risks associated with negative gearing. Number 2, capital gains tax discount. We've already mentioned this in the previous tip, but if you hold your investment property for more than 12 months, you may be eligible for the capital gains tax discount. This allows you to reduce the taxable portion of any capital gains realized when selling the property by 50%. Number 3, depreciation deductions. You can claim depreciation deductions for the wear and tear of certain assets within the property, such as appliances or fixtures. So things like flooring, carpets, curtains, washing machines, fridges, and furniture. Number 4, deductible expenses. Ensure you claim all eligible expenses related to your investment property. This can include property management fees, insurance, repairs and maintenance, council rates, and interest on loans. Yes, you heard right. You can actually borrow money and claim a deduction on the interest if it helps you create income. Again, please keep detailed records and receipts to support your claims. And please remember, while reducing tax is a legitimate goal, it's essential to comply with all the Australian tax laws and regulations. If you do have a rental property, I would strongly recommend speaking with a tax accountant who will be able to draw up the best tax efficient strategy for you and make sure they're legit. The next way to reduce tax is to take advantage of small business concessions. If you are a small business owner, consider taking advantage of various tax concessions which you are entitled to. This may include the following. 1. Small business tax offset. Small businesses with an annual turnover below a certain threshold can claim a tax offset which helps reduce their tax payable. I'll leave a link down below to this page on the ATO site so you can check out if you're eligible. You can potentially save up to $1,000 per year. Number 2, instant asset write-off. Small businesses can immediately deduct the cost of eligible assets such as equipment and vehicles up to a certain threshold rather than depreciating them over time. The ATO has announced as part of the new budget that they are increasing the instant asset write-off threshold to $20,000. So go check it out and see if you qualify. Number 3, simplified depreciation rules. Small businesses can benefit from simplified depreciation rules, allowing them to claim accelerated deductions for eligible assets. Again, go check out the ATO site if you would like to learn more. If you have a small business or you're thinking of starting a small business, then I would recommend seeing a tax accountant to help you structure their business to make it as tax efficient as possible. The next way to reduce tax is to make use of government incentives. There are several government incentives out there that helps you reduce tax. One example is the First Home Super Saver scheme, which allows you to save for your first home inside your superannuation fund, potentially benefiting from tax advantages since you are taxed at 15% rather than your higher marginal rate. It could also potentially help you save for a deposit faster. You need to be at least 18 years old and have not previously owned a property in Australia. So this incentive allows you to make voluntary contributions into your super and withdraw the money when you are ready to buy your first home. So it's similar to salary sacrifice, but you won't have to wait until preservation age to withdraw your money. You can contribute up to $15,000 per financial year and up to $50,000 in total across all years. When you are ready to buy your first home, you can contact the ATO and request for the release of your savings. The ATO will then instruct your super fund to release the amount you are entitled to. This is still a bit of a new incentive, so I would recommend speaking to a tax accountant to make sure it will benefit your personal circumstance. The next way to reduce tax is to buy private health insurance to avoid paying the Medicare levy surcharge. The Medicare levy surcharge is an additional tax imposed on high-income earners who do not have private health insurance. In Australia, everyone already pays a 2% Medicare levy, but if you earn more than $93,000 as a single household, you must pay a Medicare levy surcharge of 1%. You can avoid paying this surcharge by having an appropriate level of private patient hospital cover. For singles, your cover must have an excess of $750 or less. For families, you must have an excess of $1,500 or less. Most private health insurance packages will be cheaper than having to pay the Medicare levy surcharge, so you may as well get it and enjoy the benefits that come with it. So if your income exceeds the threshold, consider speaking to a few private health insurance companies and find a package that best suits your needs. Please make sure you double check with them that the package you choose exempts you from the Medicare levy surcharge. Then every year when you do your tax return, you can enter your health insurance details and they will automatically exempt you from the surcharge. As always, make sure you keep all your receipts and invoices. Just a quick disclaimer, I am not a tax accountant and this video is general advice for educational purposes only. If you would like a personalized tax strategy, then I would encourage you to go see a tax professional. Please use the information in this video as a guide only to do your own research. Having said that, let's move on. The last way to reduce tax is to regularly see a tax accountant. I know I've already mentioned seeing a tax accountant a few times in this video, but I think it deserves a category of its own. If you own a business or multiple investments, then I would highly recommend seeing a professional tax accountant if you haven't done so already. A good tax accountant is worth their weight in gold because they will save you thousands in tax over the years. And the best part is their fees are usually tax deductible as well. A tax accountant can legally structure your business or investments to be as tax efficient as possible. Remember, they do this for a living and are up to date on all the latest tax laws and incentives. Here are some reasons why tax accountants are important for reducing tax. Number 1, expert knowledge and experience. Tax accountants are professionals who have specialized knowledge and expertise in tax laws and regulations. They stay up to date with changes in tax legislations and understand the complexities of the tax system. Their in-depth knowledge allows them to identify legitimate deductions, credits, exemptions, and other tax saving strategies that you may overlook. Number 2, maximizing deductions and credits. Tax accountants are skilled at identifying deductions and credits that can lower your taxable income. They analyze your financial situation, review your expenses, and ensure you claim all your eligible deductions. Number 3, strategic tax planning. Tax accountants can develop personalized tax strategies to optimize your tax position. They consider your specific financial goals, investments, and business structure to come up with tax-efficient strategies. By planning in advance and making informed decisions, they can help you minimize your tax burden both in the short and long term. Number 4, personalized advice. Every person's tax situation is unique. Tax accountants provide personalized advice based on your specific circumstances. They assess your financial records, evaluate tax implications, and offer guidance tailored to your needs. They can answer your questions, address concerns, and provide clarity on tax matters. And this will definitely help you make better decisions. By the way, if you're enjoying this video, then you know the drill, guys and girls. Leave me a comment down below. What is your favorite way to save tax? I always enjoy reading through all your comments and I try to reply to every single one. Oh, and the secret word today is source, so if you mention it down below, I'll know you're one of the legends who made it this far into the video. And if you're new around here, what are you waiting for, mate? Subscribe to the channel and join the family. We have built such a fun community in the last year and I truly love you all. So those are 8 ways to legally reduce your tax in Australia. I know a lot of you come to my channel to learn about investing in shares, so if you want to learn more about how to reduce tax on shares, then check out this video on screen where I discuss more tax strategies in greater detail to help you save money during tax time. Thank you for watching, I appreciate you, and I'll see you in the next video.